Something just broke over the weekend. And if you're watching this before Monday's open, you need to hear it before the first candle prints. Saturday afternoon, with markets closed and most traders logged off, President Trump pulled the plug on the Iran peace talks. Special envoy Steve Witkoff and Jared Kushner were already packing for Islamabad. The Iranian foreign minister was already in Pakistan. Pakistan was hosting the entire mediation effort. And then Trump posted on Truth Social, "Trip canceled. We have all the cards. They have none. If they want to talk, all they have to do is call." Iran's foreign minister immediately left Pakistan, then flew to Oman, then to Russia, where he meets Vladimir Putin on Monday. This is not a rescheduling. This is a collapse. And it landed at the worst possible moment for the global economy. The Strait of Hormuz, the most important oil choke point on Earth, is essentially closed. Iran has blockaded it. The U.S. has blockaded Iran in response. Where 130 ships used to transit daily, only 5 ships moved through on Friday. The Pentagon just told Congress in a closed-door briefing that clearing Iranian sea mines from the strait could take up to 6 months. Brent crude already pushed past $105 a barrel last week before this news even hit. Silver closed Friday at $75.69. By the time you're watching this, that number is already history. Because Sunday futures will open in a few hours, the cash market opens Monday morning, and there is essentially no way silver opens unchanged. In the next 22 minutes, I'm going to walk you through exactly what just happened, why it matters way more than people realize, the 3 specific scenarios for how silver opens on Monday, the signals to watch in the first 2 hours of trading, and the difference between a 1-week event and the start of a multi-week structural shift. This is not a drill, and this is not financial advice. Talk to a qualified advisor. Position carefully. Silver just dropped 38% from its January high. It can move violently in either direction. You're here for analysis, not instructions. Let's go. Let me give you the clean facts because every layer that follows builds on this. On Saturday, April 25th, with U.S. envoys Steve Witkoff and Jared Kushner about to board a plane for Islamabad, President Trump canceled the trip. He did it minutes after Iran's foreign minister Abbas Araghchi left Pakistan for Oman after spending a full day in Islamabad without ever sitting down with American officials. Trump's stated reasons. The flight was 17 hours each way. Iran's previous proposal wasn't good enough. There's tremendous infighting and confusion inside Iran's leadership. And the U.S. has all the cards. He told reporters Iran can simply call him on the phone if they want to talk. Iran's response was immediate and sharp. President Masoud Pezeshkian told Pakistan's prime minister that Iran would not enter imposed negotiations under threats or blockade. Foreign Minister Araghchi said Iran has yet to see if the U.S. is truly serious about diplomacy. Then Araghchi flew to Oman to meet the Sultan, then announced he was flying to Moscow to meet Putin on Monday. Now here's the broader context that makes this much bigger than a canceled meeting. The U.S.-Israel-Iran war started on February 28th. Trump promised it would last 6 weeks. We are now on day 58. The fighting has paused under a fragile ceasefire that Trump unilaterally extended last week without setting a new expiration date. Iran called the extension meaningless because the U.S. naval blockade of Iranian ports is still in effect. And the Strait of Hormuz, where roughly 20% of the world's oil normally flows, has been turned into a war zone. Iran has effectively closed the strait, allowing only its allies through. The U.S. Navy is now actively clearing Iranian sea mines from the strait. As of Friday, only 5 ships transited the strait. Before the war, that number was over 130. Iran is also seizing tankers it says have violated its rules. The U.S. has redirected 37 ships through its blockade of Iranian ports. Republican Senator Lindsey Graham, one of the most hawkish voices in Congress, just praised Trump's cancellation and said U.S. military engagement may be required to regain control of the strait. So when this cancellation news hit on Saturday, it didn't land in a calm market. It landed on top of an active naval war, a closed shipping lane, oil at $105 a barrel, and the global economy already absorbing a fuel rationing crisis. That's the situation silver is waking up to on Monday morning. Let me explain why this isn't just a Middle East story. The Strait of Hormuz being closed isn't a regional inconvenience. It's a global supply chain emergency, roughly 1/5 of the world's oil. And a huge chunk of the world's liquefied natural gas normally pass through that 21-mile wide passage every day. Take that out, and global energy prices reprice fast. Brent crude was already up more than 11% last week. That's before this weekend's news. WTI was tracking right behind it. Sunday futures will give us the first read on how seriously markets are taking the breakdown of negotiations. But every energy desk on Wall Street spent Saturday recalibrating their geopolitical risk premiums. Now here's why that matters for silver specifically. There are 3 transmission channels. Channel 1, the safe haven rotation. When geopolitical tension escalates, capital rotates into hard assets. gold, treasuries, the Swiss franc, the Japanese yen, and increasingly silver. This is not rational analysis. This is risk management. Institutions holding equity exposure or risk on commodities need to hedge that exposure fast. Silver sits squarely in that rotation path. Channel 2, the dollar question. This is where most retail commentary gets it wrong. The conventional assumption is geopolitical tension equals dollar strength. Often true, but not always. If a geopolitical event raises questions about U.S. foreign policy credibility, about whether American commitments are durable, about whether a U.S.-led negotiation can be trusted to follow through, the dollar's safe haven premium can actually erode. Trump just canceled a peace negotiation his own team had set up. The Iranian president is now calling Putin instead of taking American calls. UK Prime Minister Starmer's office made a public statement Sunday that pointedly did not mention Trump's cancellation. America's allies are nervous. When the world's reserve currency starts looking less like a stabilizing force and more like a wild card, gold and silver benefit. Both rise faster than the simple risk-off math would suggest. Channel 3, the compounding fragility premium. We are in an environment with multiple geopolitical stress points already active. The Iran war, Ukraine, Gaza, Lebanon. Hezbollah is being attacked daily. China-Taiwan tensions, trade wars, central bank policy divergence, debt sustainability questions. When you're already carrying a meaningful uncertainty premium, and another shock lands on top, the effect is not linear. It compounds. Because each new piece of bad news raises the bigger question. Is the global system more fragile than markets had assumed? That single question, asked at scale across institutional risk desks, drives some of the biggest risk-off moves in modern markets. And that question is now squarely on the table heading into Monday. Now let me explain why silver's reaction to this kind of event is more complicated and more interesting than gold's. Silver plays two completely different roles in the global economy, and those roles can pull in opposite directions at the same time. Role 1, monetary metal. Silver has been money for thousands of years. When geopolitical stress elevates demand for hard assets, silver participates in that rotation. The silver market is much smaller than the gold market, which means when institutional money rotates in, the price impact per dollar of capital is disproportionately large. This is bullish for Monday. Role 2, industrial commodity. Roughly 60% of annual silver demand comes from industrial use. Solar panels, electronics, EVs, medical devices, defense systems, AI data centers. Industrial demand is directly tied to economic activity. If this Iran escalation contributes to a real deterioration in the global economic outlook through higher oil prices choking growth, supply chain disruption, recessionary signaling, then silver's industrial demand component faces serious headwinds. So you have two forces running at the same time. Safe haven, buying pushing silver up. Potential industrial demand concerns creating resistance. Which one wins? It depends on the time frame. In the immediate term, the first 24 to 72 hours, safe haven dynamics almost always dominate. Capital doesn't pause to analyze solar panel demand forecasts during a geopolitical shock. It rotates fast. Over the medium term, the next 2 to 4 weeks, the industrial picture matters more. If the Iran event proves to be a contained escalation, the risk premium fades and silver reverts toward fundamentals. If it proves to be the start of a real deterioration cycle, the industrial drag becomes more visible, even as safe haven demand persists. For Monday specifically, the safe haven play is your primary driver. But hold both ideas in your head, because the interplay between them defines where silver goes over the next month, not just the next session. One more wrinkle. Silver, going into this weekend at 75.69, was not at a level of obvious undervaluation. It was sitting in a position of elevated price after a long correction from $121 in January. That means the safe haven bid is being applied to a market that was already somewhat extended, which changes the shape of any move. A safe haven bid into an undervalued market moves cleanly. A safe haven bid into an already elevated market can spike, retrace, then find a new level. That's why Monday's open is going to be unpredictable, and why I want to walk you through 3 different scenarios instead of just giving you one. Here are the 3 most likely scenarios for how silver opens on Monday, what each one looks like, and what it means for the next 48 hours. Scenario 1, the clean spike, probability, meaningful, the most likely outcome statistically. Silver gaps significantly higher on the Sunday evening futures open and continues climbing into the Monday cash session. Early move is to $78. If oil prices spike hard with Brent pushing toward $110 or beyond, silver could test $80 to $82 in the first session. This scenario looks clean from the outside but is actually dangerous to chase. The first 30 minutes of Monday are almost guaranteed to be erratic. Wide bid-ask spreads, algorithmic noise, retail panic buying, institutional risk managers placing reactive hedges, The first candle on Monday will be the most misleading candle of the week. People who chase the open frequently buy the high of the day. Scenario 2, the delayed reaction, probability, also meaningful, especially if Sunday evening news flow stays measured. Markets don't always react immediately to geopolitical events. Sometimes the initial response is muted. Participants wait for more information. Institutions hedge with options instead of taking outright positions. The big move comes Tuesday or Wednesday after the picture develops. In this scenario, silver opens close to 75, 69, maybe a small gap higher. Trading is choppy in the first session. Volume is below average. Then over the following 24 to 48 hours, as oil markets fully digest the implications, as official statements come in from Russia after Aragchi's Putin meeting, as congressional reactions sharpen, the real move begins. This is actually more dangerous than the clean spike because the muted Monday open creates a false sense of security, right? Before the real institutional repricing begins. Watch for flat or slightly positive. Monday followed by accelerating moves Tuesday. Scenario 3, the fake move and reversal. Probability, lower but real. Silver spikes hard. Monday morning on the Iran narrative, up sharply in the first 30 minutes. Then a diplomatic clarification emerges. Maybe a State Department softening. Maybe a back-channel signal that talks are paused rather than fully broken. Maybe Putin tells Aragchi to take Trump's call. Suddenly the safe haven premium has no fundamental support. The reversal can be as fast and as sharp as the initial spike. The same participants who bought the risk-off move are now exiting at the same time. In this scenario, silver ends Monday lower than where it opened. Anyone who chased the morning spike, especially without a clear exit plan, is holding a losing position in an asset that's now technically weaker than it was Friday. This is why the first candle Monday is the most misleading candle of the week, the signal to watch for this scenario. Any official language using words like pause, recalibration, or open to resuming. That dramatically changes the probability map. Let me give you the specific things I'm watching as the week opens, because analysis without action signals is just commentary. Signal 1, crude oil, Sunday evening, futures open, WTI and Brent. This is your first read on how seriously the market is taking the breakdown. A gap higher of more than 2% on Sunday evening is a strong signal that the risk-off trade is real and likely to persist through the week. Less than 1% movement suggests the market is treating this as a manageable escalation rather than a systemic threat. Brent already closed Friday above $105. If we open Sunday at $108 or higher, that's confirmation. If it stays flat or pulls back, that's a different story. Oil is your first filter. Watch it before you look at anything else. Signal 2, the gold-silver ratio. How many ounces of silver it takes to buy 1 ounce of gold. This ratio is one of the most informative indicators in a precious metals rotation. If the ratio compresses, silver outperforming gold, it suggests the market is treating this as a broad precious metals rally, bullish for silver. If the ratio expands, gold outperforming silver, it suggests the flight to safety is preferring gold's pure monetary character over silver's industrial side, less bullish for silver specifically. Watch this in the first hour of Monday. It tells you the character of the move. Signal 3, the dollar index, the DXY. If DXY rises sharply, the dollar safe haven trade is dominating. Silver's move in dollar terms may be capped even if precious metal demand is real. If DXY stays flat or weakens despite the geopolitical shock, that's an unusual and very bullish signal for silver specifically. It would mean global capital is questioning the dollar's safe haven status, which is exactly the structural shift the gold and silver bull case has been waiting for. Signal 4, U.S. 10-year Treasury yield. When risk-off happens, Treasury demand typically rises, pushing yields down. If you see 10-year yields falling Monday morning while silver rises, that's a coherent, confirming signal that the safe haven trade is broad-based and institutional. If yields are rising while silver is also rising, that's a more confused signal that suggests position-specific buying rather than a clean risk-off rotation. Signal 5, specific silver price levels, $75.69 going into the weekend. Above that, the next resistance area is $78. A breakout there opens a path to $80 to $82. Above $82, the technical setup changes materially and momentum traders will pile in. On the downside, $74 has been tested twice in recent weeks and held. Below $74 with conviction is a warning. Below $72 on a daily close means the bears are back in control and the safe haven trade failed. Signal 6, diplomatic statements in the first 12 hours. Watch for any official statement from the U.S. State Department, the National Security Council, the Iranian Foreign Ministry, Russia's Foreign Office, or Pakistan's mediation team in the first 12 hours after markets open. Any softening of language, any indication talks could resume dramatically changes the calculus. Any hardening, additional sanctions announcements, military positioning, the U.S. Navy escalating its blockade, amplifies the safe haven case. Aragchi meeting Putin on Monday is the single biggest wildcard. If Russia moves visibly closer to Iran, that's a significant escalation that markets will reprice immediately. Let me map out how I expect this event to actually move through the market. Because Monday's open is just the first chapter. Monday open, first 2 hours, maximum uncertainty, wide spreads, erratic price action. Volume could be very high if institutions actively reposition, or surprisingly low if everyone is waiting for confirmation. Do not treat the Monday open as a reliable price signal. It's a liquidity event, not a price discovery event. Monday afternoon, the clarification phase. By midday, the first wave of professional analysis is out. Diplomatic statements, or the conspicuous absence of them, will have been logged. Oil markets will have had several hours to digest. This is when price action starts to have actual signal in it. Watch the silver price at 2 p.m. Eastern. Where it is relative to Friday's close is meaningful. Tuesday into Wednesday, the real trade. In my experience with geopolitical events of this type, the most meaningful price move often develops not on Monday, but on Tuesday and Wednesday. After the initial shock is absorbed, after secondary analysis is published, after the institutional community has fully reassessed. If silver is going to make a genuinely significant move on this news, expect the directional conviction to be clearest in the Tuesday-Wednesday window, the 48-hour rule. Events that produce sustained moves tend to show their cards within 48 hours of the initial shock, either through escalation, more sanctions, military movement, allied reaction, or through clear de-escalation, fresh diplomatic openings, official walkbacks. If by Tuesday evening the situation has neither escalated nor clearly de-escalated, and silver has given back a chunk of any Monday gains, that's a signal that this event lacks the durational power to drive a multi-week trend. It becomes a spike, not a shift. If by Tuesday evening the situation has escalated, with new sanctions, military signaling, or Russian alignment with Iran, the probability of a multi-week silver trend goes up substantially. The question that separates short-term traders from real macro thinkers is this. Is this a one-week event or the start of a multi-week shift in the risk environment? The honest answer is we don't know yet, but we can identify the conditions that will tell us. One-week event conditions. The Iran situation stays contained, no further escalation, no new sanctions, no U.S. military signaling. Diplomatic back channels quietly reopen within 7 to 10 days. Trump and Iran resume talks on the phone like Trump suggested. Silver spikes, the risk premium fades, the market returns to its prior anchors. Trade was real, but short-lived. Multi-week shift conditions. The cancellation is followed by additional deterioration, new sanctions language, allied reactions, Russia openly aligning with Iran, the Hezbollah situation in Lebanon escalating because the ceasefire collapses, new oil supply disruption signals, possible U.S. military engagement in the Strait of Hormuz. Republican Senator Lindsey Graham just publicly suggested this on Saturday, saying U.S. military engagement may be required. If even half of those conditions materialize, silver isn't reacting to a headline anymore. Silver is repricing into a genuinely new geopolitical baseline. That is the scenario that produces multi-dollar, multi-week moves, the kind people remember. What I want you to carry into the week. Don't just watch silver's price. Watch whether the underlying geopolitical situation is stabilizing or compounding. Because not any single Monday candle is what tells you whether this is a trade or a trend. The difference between those two things is enormous. Let me bring this back to where we started. President Trump canceled Iran peace talks on Saturday afternoon. Iran's foreign minister is meeting Vladimir Putin on Monday. The Strait of Hormuz is essentially closed. The U.S. is enforcing a naval blockade of Iranian ports. Brent crude is above $105. Pentagon says clearing Iranian sea mines could take 6 months. Silver closed Friday at $75.69. Going into one of the most uncertain Monday opens this market has seen in a long time. Every time a geopolitical event breaks over a weekend, there are two types of people watching markets. The first type spends Sunday night anxious, refreshing prices, reading takes they can't verify, feeling like the world is moving and they're standing still. The second type spends Sunday night prepared, not because they know what Monday will do, nobody does, but because they understand the structure of what's happening well enough that when the market opens, they're not reacting to a surprise. They're observing a system they already mapped. That's what this video was built to do. Hand you the map. You now have 3 scenarios for Monday's open, 6 signals to watch in the first 2 hours, the 48-hour rule for separating spikes from shifts, and the conditions that distinguish a one-week event from a multi-week structural repricing. When the open hits, however it hits, you're reading it, not chasing it. I want to hear from you. What's your prediction for silver's Monday open? Spike, delayed reaction, or fake move? Drop your call in the comments along with the price level you're watching. I read every single comment, and the discussion is genuinely the best part of running this channel. If this breakdown helped you walk into Monday with a clearer head than you had Saturday morning, hit subscribe. Share it with one person you know who's holding silver and trying to make sense of this. The next 30 days are going to be wild, and I'll be here breaking down every move as it happens. Iran headlines, FOMC reaction on April 29th, COMEX inventory updates, oil market shifts, all of it. The video on screen now is my full breakdown on the structural silver case beneath this geopolitical noise. Watch that next. Because if Iran is the spark, the structural setup is the fuel. Understanding both is how you actually navigate this market. Stay sharp, stay disciplined, don't chase the open.